The United States economy is in free fall. The only way to get a handle on the inflation is you've got to break it. You've got to allow the economy to collapse. So they will raise rates until you have a bond market collapse. And they've already collapsed. So markets are trying to figure out, is it time to look over the horizon and will they recover? Are we getting back to business as usual? Or is this structurally, meaning a multi-year secular bear market?
Hey guys, welcome back to Library of Wealth. Today we have Bitcoin bull Max Keiser on the Max and Stacy report, giving us an update on Bitcoin, stocks, and how inflation is affecting every market around the globe. Keiser explains that we're headed for a secular bear market, which many investors refuse to believe. Max also discusses the Fed's aggressive buying of bonds to make sure they don't reflect the true underlying fundamental economics of the US and global economies. As we see the decline into recession and prices decreasing, Keiser has noticed that now those in charge of money printing are legally taking capital from people in numerous ways. Let's listen to Max Keiser as he talks about the future success of Bitcoin and the crypto market, and how inflation will impact every market in the next few months. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
Is the bond market truly facing an existential crisis? Will it ever come back? Were we right for the last 5-6 years? Stacy.
Well, Max, that's quite interesting because, of course, when a market changes from a bull to a bear or a bear to a bull, one thing that is typical of these sort of shifts in a total, secular change from one market to the other is the denial of the disbelief in the participants, whether they're bulls, that they refuse to believe that a bear market is emerging and that all their losses, if they just keep on hanging on, they'll get back to a new all-time high. The same with the bear. Of course, we've been in a 40-something year bull market in bonds, and many people on the various programs that we had over the years have called the end of the bull market, and they got annihilated. It was called the widow trade. And of course, now it looks like it's actually over. And one thing that you could see that is kind of indicative of this is that we've seen basically the bond vigilantes back in charge, certainly with the United Kingdom, where the bond market basically forced out the Chancellor of the Exchequer, Kwasi Kwarteng. So we saw him ousted after just like a month, less than, a little bit over a month in office, and he was ousted.
So in 1987, the crash of 87, it brought about the plunge protection team, and stock markets were not functioning with supply and demand dynamics anymore. It was based on the S&P futures contracts buying done in Washington to keep the stock market afloat. In 1993, as you allude to, under Bill Clinton, remember the bond market had a drawdown of, I guess, maybe 4% or so. This was considered catastrophic, and the decision to euthanize the bond vigilantes was made. And since 93, we haven't had any real price discovery in the bond market either, because the Federal Reserve became more aggressive in buying back bonds to make sure that they would not reflect the true underlying fundamental economics of the United States economy or the global economy until 2022. So like when you hold a beach ball down under the water, you keep going deeper and deeper, it gets harder and harder. Eventually you lose the grip and the beach ball pops to the surface. In this case, that beach ball popping to the surface would be yields or interest rates as the bond market plunges after many years of artificial bond manipulation for the prices. And right now, you've already had the biggest bond collapse in recorded history. You remember interest rates were at 300-year lows, and they've already collapsed. So markets are trying to figure out, is it time to look over the horizon and will they recover? Are we getting back to business as usual? Or is this structurally, meaning a multi-year secular bear market in bonds? I think that's the question people are trying to get their hands on right now. I would posit that we're into a structural secular bear market.
Keiser notes that for the first time in forever, global central banks are increasing their rates. This causes the dollar to climb and pandemonium to ensue in the market. He says that the banks are trying to get interest rate neutrality while trying to avoid absolutely demolishing the global economy. Keiser advises holding on to all Bitcoin because it has future merit and cannot be destroyed by money printers.
Because remember, it's been over 40 years where the Fed has continuously been able to lower rates. Everybody's been able to roll over their debt at a cheaper and cheaper and cheaper. They could extend and pretend. The US government, all governments, municipalities, corporations, individuals have been able to roll over their debt, increase the asset value of their portfolio, whether it's stocks, whether it's, their house prices. If it was genuinely the end of the bull market, what you saw in January, February, March of this year was definitely a parabolic move in the US housing market. Like that had never been seen before in the United States, but you were definitely seeing that. And now it's, of course, collapsing as mortgage rates have doubled in the past just few months.
Right. So the interest rate, the 10-year Treasury, is at the fulcrum of all financial activity because it all is based on credit. And the price of credit is depending on how the economy is structured. And we have winners and we have losers. For years, the losers were the pension funds who were getting zero on their money markets or passive investments. Now they're getting 2.5% on a money market, and some banks are offering certificates of deposit paying 4%. So that's the first time we've seen that in many, many years. And I think you're going to get to a headline at some point talking about our friend Jamie Dimon at JP Morgan. Of course, they're sitting on over $1 trillion and they're making record income on that cash. And that brings about a lot of other questions. It's a market, it's an economy, it's a world, it's a country where we have heads you win, tails you lose. No matter what the interest rate scenario is, guys like Jamie Dimon and the Wall Street bankers and the hedge funds and the central bankers are never, ever going to lose because they're always going to front run these markets. They're always going to structure their portfolios in a way to maximize their return no matter what the situation is because they have ways to mitigate risk and manage risk. The average person, which means 330 million Americans, has no way to manage their risk structurally or predictably. So they're the ones that always take it on the chin. And once again, they're getting hit again.
JP Morgan CEO says its bank is sitting on 1.2 trillion of cash. As Max pointed out, they'll be collecting more and more interest on that. Of course, the ordinary American has almost zero in cash and savings. They have huge piles of debt. And one thing, of course, people always argue is that, well, inflation is great during that time. Well, of course, what the Fed is trying to do to slow inflation is to wreck the economy. They openly state they need people to lose their jobs in order for inflation to be tamed. So the job losses will be coming, but they don't have the benefit of having any savings to capitalize on the rising interest rates. In fact, their debt servicing costs are going up. So all they have is debt. Of course, in a sort of beggar thy neighbor policy that you're seeing in this period of deglobalization and de-dollarization is you're going to see more and more, especially as we head into the next general election season. And what you'll see then is more and more debt forgiveness for Americans. They'll be able to write off like all the constituents who might vote for the next candidate. Joe Biden says he's going to run again, but they'll write off more and more debt. Right now, they've written off some student debt. They'll write off mortgage debt, they'll write off car debt, they'll write off all sorts of debts because, of course, they won't be able to service it.
Keiser stresses the importance of Bitcoin's perfect collateral. One of the biggest indicators that we're about to experience a major collapse is the doubling of mortgage rates in the past few months. The same thing happened in 2008 when the housing market collapsed because big banks were over-levered with bad debt. Hedge funds have ways to mitigate and manage risk, so it's the average American that will feel the economic impact of banks repeating these same mistakes, only this time there are multiple markets that are on the brink of falling. What do you guys think of Max Keiser's opinion on the need for Bitcoin and what we can expect economically in the next few months? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.